Welcome back to The Explainer. Today, we are putting on our financial detective hats and cracking open the spreadsheet for Arcosa, ticker symbol ACA. We're going to filter out the market noise and figure out what the numbers are actually telling us about the true health of this company. Now, Arcosa has been making some serious waves lately, catching the eyes of momentum traders and value analysts alike. But as anyone who follows the markets knows, the surface narrative, it rarely tells the whole story.
So let's kick things off with an absolutely massive number, a 52.35% trailing 12-month return. If you've been holding Arcosa over the last year, you're probably feeling pretty fantastic right about now. Outperforming the broader market by that kind of margin is exactly what gets the stock buzzing on financial forums and lighting up trading screens. But a number this big immediately raises a critical question for us. Is this a fundamentally driven breakout or just a speculative short-term spike?
To figure that out, we've got a quick roadmap. First, we'll look at Arcosa's massive recent run. Second, we'll dig into the revenue, profits, and growth. Third, cash flow and dividends. Fourth, we tackle valuation. Is ACA overpriced? And finally, we'll wrap up with the big takeaway.
All right, part one, Arcosa's massive recent run.
We've got a really jarring contrast in the data here. On one hand, there's this recent explosion in returns, that 52.35% over the last 12 months, and an even more impressive 80.87% over a 3-year period. But if you zoom out to a 10-year period, it's utterly flat, a 0% return. In fact, digging into the raw source data, the 15 and 20-year compound annual growth rates are also sitting at exactly 0. This tells a fascinating story. Arcosa was essentially a dormant stock for a decade, completely flatlined, before suddenly waking up and going on an absolute tear over the last 3 years. Just to put the sheer velocity of this recent move into perspective, the stock rallied from a 52-week low of about $81.59 all the way up to a recent close of $124.76. That's nearly a 53% surge right from the bottom. For a mid-cap company sitting at roughly a $6.1 billion market cap, adding that much value in such a short window means something fundamental must have shifted in how the market perceives its future earning power.
Moving right along to part two, revenue, profits, and growth. Let's see what's actually going on under the hood.
Okay, this is where things get genuinely wild. Check out these trailing 12-month growth rates. The top-line revenue grew at a highly respectable 12.20%. That's solid, steady business growth. But as we move down the income statement, the leverage is just staggering. Arcosa's net income didn't just grow, it more than doubled, hitting a 122% growth rate over the trailing 12 months. And the bottom line? Earnings per share skyrocketed by nearly 770%. I mean, when revenue grows by 12%, but EPS jumps by almost 770%, you are looking at a company that either pulled off a massive operational turnaround, aggressively slashed costs, or benefited from highly favorable pricing dynamics that dropped straight to the bottom line. And the underlying metrics brilliantly illustrate this new operational efficiency. With the gross profit margin sitting at 21.05%, the core economics of their products and services are undeniably healthy. Their return on invested capital, ROIC, is at 6.54%, which, get this, is actually up over 44% compared to its 3-year average. And while that net profit margin might seem a little slim at 4.51%, the source data reveals this is actually a massive 60% improvement over its trailing 12-month average. Simply put, Arcosa is squeezing a lot more actual profit out of every single dollar of revenue than it has in recent history.
Which brings us to part 3, cash flow and dividends, the fuel keeping this whole operation running.
Over the trailing 12 months, Arcosa pumped out $175.5 million in free cash flow. Now, free cash flow is the lifeblood of any business, right? It's the real money left over after paying operating expenses and capital expenditures. It's the cash management uses to pay down debt, buy back stock, or issue dividends. But here's the catch. The data reveals that this metric is actually down nearly 44% year over year. That is a stark contrast to their booming net income. And that kind of divergence is exactly the sort of thing every careful investor needs to keep on their radar. So what is management doing with the cash they do have? Well, if you're hunting for income, Arcosa is definitely not your vehicle. The dividends are entirely stagnant, with a 0% growth rate over the last 3, 5, and even 10 years. They offer a microscopic 0.16% yield while maintaining a very conservative payout ratio of less than 5%. This clearly communicates that management is retaining almost all their capital, likely funneling it right back into the business to fuel that top-line growth rather than handing it back to shareholders.
So, the engine is roaring with newfound operational efficiency, and the stock is undeniably soaring.
But we really have to ask ourselves, are we overpaying for the ride? Because growth is wonderful, but only if you're buying it at a reasonable price.
Let's find out in Part 4, Valuation. Is ACA officially overpriced? Here is the crux of the whole situation. The market is happily pricing Arcosa at nearly $125 a share today. However, when we run the discounted cash flow models based on their actual fundamentals, the fair value price is only sitting at $105.23. The market has completely gotten ahead of the intrinsic value here. This stark difference means investors buying in today are staring at a negative 18.56% margin of safety. In the investing world, your margin of safety is your cushion against unforeseen economic downturns or, just simple miscalculations in a company's future growth. Right now, not only does Arcosa offer absolutely zero cushion, but you are literally paying an 18.5% premium over its calculated fair value just to own a piece of this recent momentum.
Let's cross-check this with some multiples to see how this premium plays out across different metrics. The price-to-earnings, or PE ratio, sits at about 29.4. Interestingly enough, this is actually lower than its 3-year historical average of 32.2, which might trick some basic stock screeners into thinking it's cheap. But hold on, let's look deeper. The price-to-sales ratio is 2.12, which is running almost 22% hotter than its 3-year average. And the EV to EBITDA ratio, which is a fantastic metric because it accounts for the company's debt, is sitting at 13.48, also elevated compared to its historical norm. The market is paying top dollar for every single dollar of sales and operational earnings right now.
And it gets even trickier if we switch up our valuation lens. That $105 fair value we just discussed was based on free cash flow. But if we base the fair value on earnings per share instead, the fair value absolutely plummets to just $71.45. If the market were to suddenly reevaluate Arcosa based purely on an earnings-driven DCF model, you'd be looking at a massive negative 74.61% margin of safety. It's a really stark reminder of just how sensitive growth stocks are to exactly which model the market decides to use on any given day.
All right, let's wrap this all up with Part 5, the final takeaway.
To put all the puzzle pieces together, we've got a stock that suddenly woke up from a decade-long nap with some absolute monster triple-digit recent growth in its net income and EPS. The company is demonstrably more profitable today than it was just a few years ago. But, and it's a very big but, this growth comes attached to a price tag that offers zero margin of safety. You're paying a hefty premium above fair value, getting basically nothing in dividend income, and banking entirely on the hope that this momentum continues unabated.
So, the million or maybe billion-dollar question is up to you. Can this incredible business momentum actually outpace the cold, hard valuation math? Or is a painful correction on the horizon when reality finally catches up to the hype? That is the defining question for Arcosa right now. Thanks so much for hanging out with me on this explainer. Keep your eyes on the data, stay sharp, and I'll catch you next time.